Well, howdy there, folks. I have a pretty incredible video planned and prepped for you here today. I've just spent the last 3 to 4 hours prepping this one. I have 61 slides to go through, an absolute beast of a video. And this is absolutely necessary because a lot of people are wondering, is this a time to be buying stocks heavy? Is this a time period to maybe be selling out of stocks and maybe cashing up a little bit and getting ready for a potential drop? And there's all these different conflicting thoughts going out there. And so I said, let me do a very in-depth video here today, a beast video addressing this. If it's actually the time to be buying, selling, cashing, just holding, we're going to talk about all that across the board. We're also going to talk about, I showed you this, guys, this little illustration I made, which is like the life of a retail trader investor life cycle. And I want to talk about where we're at in that cycle in this video here today as well. Now, I hope you guys have had a very good year overall out there. You should have made a lot of money this year so far. If you have made money in the market this year, let me know in the comments section, okay? If you want to be specific on how much money you made this year in the stock market, then you can do that in the comments section. But I would just love to hear from you guys. I hope you made some dang money this year because there's been a lot. I mean, a lot of money to be made this year, and there's going to be a ton of money to be made next year in the market as well, okay? And so it's just going to be from maybe, let's call it, different places. I appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. I appreciate each and every one of you. And make sure right now, you go down to the pinned comment down there and enter in your info and get ready to rock and roll for the sale that we have coming. About 400 of you guys have entered already to get access to that for Black Friday. Every single one of you guys needs access to that, okay? This is the No Jokers Holy Smokers deal. It's 8 days away at this point in time. Unless you're in my private stock group, which is the only thing above this really, unless you're in my private stock group, you need access to this. My Become a Master Stock Market full course, plus ability to see what I'm up into in the market, how I'm diversifying my funds around, like that is the real deal Holyfield for $62 access to that. It's a no-brainer, okay? All right, guys, so let's get into this, all right? Meta stock has been an absolute animal this year. You know, we're up 171% on the stock now at this point in time. We're up $382,000. If you own Meta stock, it seemed like the best time in the world, right? Tesla stock has had an absolutely incredible year. We're up 929%. Obviously, you know, $365,000. Obviously, I was in Meta way before this year, right? But this has been a stock that's performed tremendous this year. Amazing's on. 33% up already on this stock. We're up $37,000. If you have bought Amazon stock in the past year, you're doing freaking phenomenal, right? Elf on a Shelf has been an amazing performer, not just over the many years, but just specifically this year as well. Look where Elf was a year ago today. Look where that stock is at today. It's absolutely incredible, right? Palantir. A lot of people at Palantir, you might be a Palantir shareholder. Let me know in the comments section if you're a Palantir shareholder. If you are, you're probably a very happy camper being a Palantir shareholder. The Palantir's performance has been utterly ridiculous this year. I'm up 125% on this stock, and I didn't even buy at the bottom in regards to Palantir. Like, I'm like, dang, man, I missed out on some even more attractive pricing in regards to Palantir. There's folks up 150, 200% on Palantir, just in the shares straight up. Never mind some folks that were buying some options. Oh my gosh, can you imagine buying some Palantir options at the end of last year or the beginning of this year? Could you imagine the gains? I mean, you're looking at 500 to maybe 1,000% type gains on those options now at this point in time. Fubo, this is a stock that was $1.04 just back in the springtime, right? Now it's $3 plus, just like that. Nvidia, 229% year to date. 229% year to date. Mr. Softy, 64% return year to date. That's ridiculous. For Microsoft, Apple has had a horrible year in their business model, but you wouldn't know it based upon the stock price. 45% up this year. Now remember the numbers, right? Because usually in the stock market, you should expect 7 to 8% if you just buy like an index fund or something like that, right? 7 to 8% a year roughly, right? And there you have Apple 45% year to date, Microsoft 64% year to date, Nvidia, and we're not even to the end of the year yet. We still got another month and a half left. Nvidia 229%. I mean, these stocks are giving gains that you would expect over a decade, several decades, being an index fund or something like that. This is, you know, and these aren't like, I've never heard of these companies before. These are hidden gems. No, these are super popular stocks, right? And so this adds to an ultra level of confusion of folks out there, right? Because they're looking out there and they're saying, damn, man, everything must be super overvalued. Everything must be a ripoff in the market. We must be in some sort of stock market bubble based upon the fact that these particular stocks have all gone up so dang much, right? Well, that's what I call an illusion. Okay, I don't know if you guys ever been driving through the desert or been walking in the desert or something like that before, and it's really hot, and you kind of see this, like, it almost looks like there's a lake in front of you, or there's a lake out there that you can get to. It's all an illusion. There's actually no lake there. There's actually no water there at all, okay? It's an illusion. And so the stock market this year, if you look at just some of those stocks I just showed you there, right, it gives you a bit of an illusion that the whole stock market must be in some sort of bubble, in some sort of overvaluation or something like that, okay? When in reality, you dig a little beneath the surface and you realize, oh, wait, maybe things are dramatically different than the illusion is really telling me. Look at a stock like Topgolf, Callaway Brands. That stock is down 42% year to date. Estee Lauder, the big makeup giant, the cosmetics giant of the giants, 52%. Year-to-date negative return for that stock. It has lost over half of its value this year for the makeup giant. Etsy is down over 40% year-to-date. Bath & Body Works, the soaps, candles, and lotions company, right? You probably in every single mall out there you could possibly imagine. If you ever go to the mall in your life, you see Bath & Body Works there. Bath & Body Works has lost nearly 30% of its value year-to-date. Align Technologies, they almost have a monopoly on the aligner type business, okay, in basically invisible braces, right? The stock is down 7% year to date. Whirlpool stock down over 24% year to date. Now, also remember, 2022 was a horrible year in the market, so many of these stocks were likely already down huge last year. So what you're seeing this year is what I call just another onslaught of the dirt on top of these companies right here. Foot Locker, and mind you, every single company I'm telling you right now, these are all super famous companies. None of these are like, wow, I've never heard of this stock before. Foot Locker, 44.4% down year to date. PayPal, 23.8% down this year. Cheesecake Factory, 6.5% down this year, even though their numbers have been incredible this year. Target, 18.5% down this year, and that's even after today's 17.7% gain, which, by the way, Target's been an easy money stock. I've been calling that for the last several months, and sure enough, it showed its easy money here today, right? I mean, think about that. 17.7% up to date, and the stock is still down 18.5% this year. Winning Resorts, their numbers have been incredible. Vegas has been hot. Macau is coming back like unbelievable. And yet Wynn stock is down 6.5% year to date. Mattel might be the most shocking one of all of them. Mattel's down 3.7% this year. And guess what? They had the biggest grossing movie in the entire world this year. In the entire world. They had the number one grossing movie, the Barbie movie. It was number one worldwide, $1.4 billion in box office worldwide, $636 million domestic, right? And they own the Barbie brand, so they can make so much licensing money off that, so many toy sales off that over this Christmas season and for years to go in the future. And yet, that stock is down year to date. I mean, how often would you ever see the company that created the number one movie, that owns the brand behind the number one movie, to be down? Like, that's just crazy to think, okay? Robinhood, this is another shocking one. Robinhood, after it already got wrecked over the last 2 years, this year it hasn't even had any gains, basically. The stock's around flat year to date. And this is with Bitcoin moving up huge and with all those big tech stocks moving up huge, right? Crazy one to think about. Nike stock down 13.4% year to date. Avant Brands, their numbers have been tremendous this year, and that stock is down 22% year to date. WK Kellogg, 26.7% this year. Check out some of these dividend stocks. Get ready to have your flapjacks flipped right onto the floor. Check this out. Pepsi down 7.6% year to date, despite Pepsi's numbers being pretty darn incredible, especially their bottom line. General Mills, the General, it's lost about a quarter of its value this year, down 24.7% year to date. Kellanova, 23% down year to date. Campbell's Flippin' Flapjack and Soup, 28.96%. That stock is down year to date. Does no one buy soup anymore? Look at Kraft Heinz. Ketchup, mustard, what are we talking here? 21.2% down year to date. Are we talking jam or are we talking jelly? JM Smucker's Company, 31.1% down year to date for that stock. Coca-Cola down around 10% year to date, right? We get into what I call the moon effect, right? There's a dark side of the moon, and then as Pink Floyd would say, the dark side of the moon. There's a dark side of the moon, there's a light side of the moon, right? And the light side is what everybody sees, and that is tech, right? That's those stocks I started out today talking about, the Apples and the Microsofts and the Metas and the Amazons and the Teslas and those sorts of companies, right? And then you basically go beneath the tech surface, and it's so dark. It's so dark. It's so dim. The stocks have done so poorly that it creates this divergence in the market where people are like, well, what are we really looking at here? Are we looking at there's steals all over the market and I should be buying right now? Or should I actually be selling and cashing up? What's actually going on here, right? So in order to illustrate this point, I need to do a little bit of a history lesson for everybody that's watching this video right now. I told you this is a good one here today, okay? We're going to talk a little history, right? I want to take you back to the tech bubble days. And it's going to lead you all up into what's happened over the last few years, where we're at right now in regards to this market, okay? If we go back to the tech bubble days, right? And we go back to let's call it 95 through 99, right? The Federal Reserve had interest rates incredibly low at that time. Now, you might look today and you say, wait, isn't that high? It was around 5% or so. For back in the 90s, it was incredibly low because prior to that, you were used to, Fed funds rate of 10%, 15%, even 20%. Fed funds rate got all the way up to 20% back in those days. So 5% back in the 90s was like 0% nowadays, essentially, okay? Literally, that's what it was. 5% back then is like 0% today. So we had crazy low interest rates during that time. Now, we probably shouldn't have had crazy low interest rates at that time because the fact is unemployment rate was actually very, very low. We were 4 or 5% during those years. And if you look back at the, prior decades, 4 to 5% is very low. So you don't usually want to have interest rates very low into what's a very good economy. And if you ask most people, how was the economy back in, 95 through 99, most people say it was pretty damn good. Back in those years, my dad started his own pool business. We were able to, he was able to save up enough money that got us out of poverty, got us out of a really bad neighborhood. And in 2000, it was 2000, 2001, we were actually able to move to a middle-class neighborhood and get out of poverty, right? Which was a huge win overall. And that was the economy back then. You could start a small business and grow it and those sorts of things, right? Now, what did this lead to? Those low interest rates tagged on with a hot economy. It led to a crazy, epic bubble like we had never seen before in the stock market, or at least hadn't seen since probably, prior to the Great Depression, okay? Crazy bubble in the market where the NASDAQ in a matter of 5 years or so went up 500+%. Absolutely insane. And this is what happens when you have too low of interest rates with too good of an economy. You end up in a situation where bubbles start to creep up all over the place, right? Now, if we think back to where the stock market was and where the economy was prior to Rona, okay? And I know not everybody was in the market back then, so that's why I'm doing this little history lesson. So whether you were in the market back then, you forgot, or you weren't in the market, you can kind of tie all these pieces together. I'm going to tie them all together for you so you understand kind of what's going on. The market in the economy prior to Rona was pretty good, okay? I mean, if we think about, from about 2016 into Rona, which is, the beginning of 2020, we had a very good stock market for those years, a very good stock market. We had one major crash correction that kind of happened late 2018, but outside of that, man, market was good. It was a good market. We had very low unemployment. We had small business that had a lot of confidence. We had a consumer confidence that was looking pretty good during that time period. We had a real estate market that looked very healthy. It trended up, but it was looking very healthy overall. And we had a very healthy stock market, okay? So prior to Rona, things were all headed on the right track. There's no doubt about that, right? And then Rona happened. And suddenly, the government pumped crazy amounts of stimulus. The Fed took rates back down to zero, right? And what ended up transpiring after you come off of a very strong economy, one of the strongest economies actually we'd ever seen, and arguably, you go back to 2019, there's some people that say that was the strongest economy we've ever had in the history of the United States, and I couldn't make that argument as well, right? And yet, the government pumped the stimulus. Obviously, the Fed lowered interest rates to zero. They did what they did. Central banks around the world did the same exact thing, right? And this led to a situation where, if you look at the NASDAQ, we over 2x the NASDAQ in about 18 months. That should never happen. The NASDAQ should never 2x in 18 months. The only time period you can really find that ever really transpiring for the most part was back in the tech bubble days. That's when you had crazy things like that happening. And so what you have happen is you have max level of risk starting to be taken in the market, right? Max level of risk. And so it begins with stocks. And then it's not good enough just to hold good quality stocks. We got to move to riskier stocks, right? Riskier stocks, because my good stock over here is just gained 50%, but look at this riskier stock over here. Yeah, it might look like crap, but it just gained 100%, right? Then even the risky stocks is not enough. So it starts moving into crypto. And then it's not just good enough to own Bitcoin and Ethereum. We got to go riskier crypto. We got to go altcoins, okay? And then when altcoins aren't enough and we got to go even riskier, the final boss showed up. And the final boss was NFTs. NFTs were the final boss of the bubble. And that was the one that finally ended the show that happened, right? And so we had the crash, right? And the difference between kind of the tech bubble crash and coming out of the tech bubble crash and the recent crash we had is, if we look at from the NASDAQ perspective, right? We have companies that actually have earnings, which you didn't really have back coming out of the tech bubble. And so the recovery coming out of the tech bubble was pretty slow because it still was in prime time for the tech companies. So although they all started to bottom around 2001, 2002, and started to come back, it was ultimately a pretty slow recovery because those companies didn't have earnings, which is very different than the tech companies we have today, which have the most earnings in the history of mankind, numbers that we've never seen ever before, right? That's a huge difference. But what happens is risk aversion, okay? Risk aversion happens in the market. And this is something that happened coming out of the tech bubble. A lot of people either got screwed in the tech bubble, right? You had online brokerages starting to take off. A lot of people got in the market. The internet was obviously taking off, and the first waves of AOL were taking off, obviously, in the 90s. And so a lot of people got in the market. A lot of people piled in 98, 99, into 2000 and got screwed and lost a lot of money, right? And then the other people that didn't also got to see that. So there was a huge risk aversion for the stock market actually for years to go after that. And actually, that risk aversion stayed with the market for actually over a decade, believe it or not. And so that's why even in the great financial crisis, a lot of people wouldn't buy stocks because they were still scared not only from the recent crash of the great financial crisis, but they were also scared of the tech bubble crash as well, right? And so a lot of people just had a view of like stocks sucked, it's just gambling, things like that. So what did people end up starting to do with their money come 2003, 2004, 2005, 2006, 2007? They weren't focused on stocks. They said that was gambling. So they said, I'm going to buy real assets, okay? And they started to pile into real estate more and more as the years went along, right? And then that ended up leading to the biggest real estate crash in the history of the United States. And not just by a small margin, but by a massive margin, right? Something we've never seen before, and something hopefully we don't ever see again, because that was crazy, crazy. Well, some people might root for that, the ones that are looking to buy a property, something like that, right? And we go to nowadays, right? To tie this back into nowadays, what are we seeing? Massive risk aversion. This is Robinhood's latest numbers. Monthly active users for Robinhood decreased 16% to 10.3 million. Robinhood, folks, had over 22 million users at their peak in 2021, okay? They've lost over 50% of their users that they had back in 2021. And there's no signs of these people showing back up. They're nowhere to be found. They have no interest in the stock market. They got into the GameStops and the AMCs and everything else, and they said, I'm not playing that game again. Screw that game, okay? They said stocks are a scam, and they're not coming back. So now, where are people putting their money? You got to ask yourself this. Is it real estate? Is it stocks? Is it crypto, or is it somewhere else? Well, let's think about this. Crypto's made its move not based upon retail. It's made its move based upon actually big money in the whales. They've made some moves there recently. It's really not any big hype around crypto. Stocks, none of the numbers we're seeing is retail. I mean, retail actually just sold the most in October that we've seen retail sell in years, which is a crazy thing to think about, right? We've seen no increase in Robinhood's amount of users, and they just keep falling. If anything, it seems like there's more retail leaving the market than ever before, right? Are they moving into real estate? Nope, nope, nope. Not real estate right now. So where's the money going? You got to ask yourself that, because there's always excess money in the system. There's always people that make way too much money, right? And they always have more income than expenses. I shouldn't say way too much money, just more income than expenses. This is where the money's going. The money's going to money market funds. If we go back to 2018, money market funds were sitting around $3 trillion. If we were to look at the numbers today, we're way over $6 trillion in money market funds, money in like short-term treasuries and those sorts of things, okay? So the retail money is now there. And that's where a lot of the money's gone, and because treasuries have been yielding 5% plus, right? And so now, in a matter of just a few years, we've basically over doubled up the amount in money market funds. That's incredible, right? So, at some point, that money, you got to understand, is going to head into these things. Real estate, stocks, and crypto. All that crazy money, and I don't say all of it, but a huge portion of that eventually will exit out of there and will go into these sorts of things. That's just a tick, tick, tick situation. It's a tick, tick, tick. The time is ticking in regards to that. It's a matter of time, right? Now, if we want to know where we're at in the cycle in regards to noob trader investor life cycle, okay, which is basically Wall Street causes volatility. Everybody talks about that volatility. Middle East, this happened. Oh, this happened over here. This happened. This is why the market's sinking, right? Retail gets scared, they sell. Wall Street comes in and scoops up all their shares for cheap. Then no one talks about whatever the scary thing was. Then everything's calm for months or years to go in the future. Retail finally thinks that the coast is clear. They all get back in. Once they all pile in, then Wall Street creates the next level of volatility, okay? So where we're at in the cycle is very important you understand. We're right here. We're in the stage right now of Wall Street buying, okay? Now, they already started this cycle on certain stocks about a year ago. They started on new stocks now, okay? But this is where we're at currently in this cycle, right? Now, there's also what I call the Wall Street money rotation game, which is a whole different ball game, okay? And this is the way Wall Street runs their money, and there's these folks all chase different things at different times. First, you have, let's say you got company XYZ, okay? So company XYZ, the stock's kind of bottomed out, it's crashed, whatever's happened, okay? It is what it is. And so you have early gang of Wall Street, maybe some of the smaller hedge funds, maybe some of the smarter money, start to enter into that stock, okay? And they create a bottom on that stock, and they actually start to create upward momentum on that stock over several months. After seeing this momentum over a few months, you have the mid-gang see that, and they're like, oh, that's where the momentum's at. That's where I need to position into. And so the mid-gang starts entering in that position. It creates the next big up run for that stock overall. And then you see the late gang enter, okay? And these are the last folks that are kind of on the Wall Street side. They're seeing, oh, that stock's the mover and shaker. That's where we got to position into. You might have certain funds and individuals and money managers that are like, I got to be associated with that stock. So they buy in, right? Because a lot of it, a lot of these high net worth individuals aren't actually fact checking things. They just want to know, like, is my fund manager in NVIDIA or not in NVIDIA, right? And so you have late gang enter in, so they can be like, oh yeah, when their client asks them on the golf course, hey, you in NVIDIA? Oh yeah, we're in NVIDIA. Yeah. Are you in Tesla? Yeah, we're in Tesla. Are you in Meta? Yeah, oh yeah, we're in Meta, right? It doesn't matter when they entered in, because a lot of times the high net worth individuals, they're not looking it over like that. Maybe a few are, but a lot aren't. They're just not. And so it's late game, right? Then what happens is the early gang after that starts to sell, right? And that stock starts to weaken. And the early gang starts to position into a new group of stocks. They start buying a new group of stocks. Then the mid gang sees all the stocks starting to really weaken, and they start seeing another group of stocks that's starting to run, and they say, okay, we got to rotate our money now. So they start selling, create a new level of selling pressure, and then the late gang, they end up doing the same, right? And they rotate that money, and then the cycle goes on and on and on. It's what I call the rotation of money in the stock market, right? Now, to illustrate this on some stocks, how this works, this is just a one-year chart of like Meta, okay? So Meta, the early gang starts to enter the stock Q4 and Q1 of 2022 and 2023, right? And the early gang gets in, and that's what pushes that stock in the first kind of big movement there that we can call from like November 2022 through about February of 2023. Then after that big run, mid-gang sees that. They say, we got to start positioning into Meta. So they start positioning into Meta. They're the next run up, okay? And then late gang starts entering Meta this summertime and kind of had been entering ever since, right? And kind of hoping for the next squeeze of Meta upward, right? A stock like Apple is a good illustration of that. early in 2023, the early gain gets in Apple, right? They believe it's bottomed and we're heading up. Then the mid gain enters in the springtime in regards to Apple. And then the summertime, you have the late gain come in and hope for a little more squeezy on this one, right? And so far, the squeezy hasn't quite been there for Apple, right? No, recently, we're getting a new rotation, and it's very clear what's going on here, okay? This is a 5-day chart of some of those really popular stocks have had tremendous years, right? I got Meta up here. I got the Qs up here, right? Meta's up 3%. Qs are up 3%. AMD's up about 3%. NVIDIA's up about 3%. Apple's up 2.6%. Google's up 2%. And Amazon's actually only up 0.7% in the past 5 trading days, right? And keep in mind, with the market as strong as it's been the past 5 trading days, what this actually spells and smells like to me is money's already rotating out of these. The only reason these stocks are green really in the past 5 trading days is because there's just been probably a lot of sideline money that's also coming in the past 5 days. But what I feel in regards to these stocks is there's actually already rotation going on here, okay? And you look at the divergence here between those stocks and look at a PayPal, for instance, up 4+% in the past 5 days. Look at Fubo, 7%. Estee Lauder, 7.6%. Topgolf, Callaway, 9.3%. RH, 10%. Target, 19%. Enphase, 20%, right? You have the early gang starting to rotate some money into some of these and out of some of these other stocks. Like I said, there's no doubt there's money being rotated out of these ones right now because they're just far too weak considering how strong the market is. And so the only reason these have gains is likely because new, fresh money has probably come into some of these stocks over the past 5 trading days, obviously since we heard the inflation numbers and whatnot, right? This is what happens, right? Now, there's no 2 years alike. A lot of people think like, oh, because this year happened, it's going to be similar to this year. I can tell you, since I got on the market 08, 09, I've never seen 2 years that are the exact same. They're so dramatically different, okay? Public account, which is now at $1.77 million, this account I started around 2018, right? Since I started that portfolio, there's been no 2 years alike. There's never been 2 years alike in a row, okay? 2018 was the year that was really marred by, in my opinion, the late year crash that happened in the market. It was a late year crash, and especially big tech stocks got absolutely pummeled toward the end of 2018. It was vicious, okay? 2019 was a completely different year. Big tech boomed in 2019. And if you look at the performance of those big tech stocks in 2019, it was freaking amazing, okay? And I remember being a great year as a Tesla shareholder as well in 2019, especially in the back half of 2019. I remember being phenomenal, right? Big tech boomed in 2019, which was very different than 2018. Then in 2020, right, especially after we had the Rona crash at first, and then after that, the riskier the better. The Fed, was going to backstop everything, and it seemed like the riskier you were in a stock, the better you were going to do overall, right? 2021 is very different. A lot of the risky stocks started to struggle in 2021. Why? Guess what? Big tech rolled in 2021. Big tech was the place to be in 2021. Those stocks performed tremendous all the way until about early to mid-November of 2021, right? 2022 was a completely different year. Tech stocks got crushed in 2022. You saw 30, 40, 50, 60, 70% falls all over the place for the tech field. Meanwhile, dividend stocks did tremendous in 2022. A lot of oil and gas stocks did tremendous in 2022. It was a phenomenal time for those stocks. They were having their cake and eating it too, right? And then here in 2023, what a different year. Tech stocks have soared this year, right? And then you go beneath tech stocks and it's like, damn, everything sucks in this market other than tech stocks. It's like, what the heck is going on, okay? Every year is so different. And so what's 2024 going to likely be, okay? Here's what's likely going to happen. 2024, I can see big tech, all these big tech stocks, and we'll talk about what stocks are overvalued and undervalued in just a moment, but I can see a situation where big tech stocks have slight gains or slight losses for pretty much across the board. I own several big tech stocks. I own several in the Magnificent Seven. I own Tesla. I own Meta. I own Amazon. Am I expecting massive epic gains in any of those 3 stocks in 2024? The answer is absolutely not. I am not. I could see those stocks either having slight gains, slight losses, performing in line with the S&P 500. This was the year to be in big tech. let me be very clear about that. It doesn't mean we can't get gains next year. It's just I think the gains are going to be extremely, extraordinarily limited compared to the gains we got this year. It's going to be like a night and day difference, okay? And there's a potential that some could go actually down in 2024. Meanwhile, I think small caps, a lot of these dividend stocks, a lot of the fintech stocks could be booming in 2024, and we could see a lot of rotation. And keep in mind, those big tech stocks are so massive that when money rotates from them, it is like a game changer for a lot of these sorts of companies because their market caps are so small. Like, you know, somebody could sell $10 billion, well, I don't say $10 billion, $1 billion of some of those big tech stocks, and it won't even put much of a dent into those big tech stocks. Meanwhile, they rotate that money into some of these, and it's a game changer for those companies. It's a game changer, right? And we know because people are always having a certain amount of their checks go to index funds and those sorts of things. We know there's always going to be some level of buying pressure for the big techs out there, right? Because guess what? The Magnificent Seven, those big techs, those stocks are, we can call it, let's call it the biggest weights of the S&P 500, of the NASDAQ, right? Where people are obviously funneling money. And so you pretty much have a week in and week out basis, money flooding into those stocks, month in and month out, money flooding into those stocks, right? Now, in my Become Master Stock Market course, I have so many videos in that go into valuing stocks, right? Which is a very important game. You got to know how to value stocks. It can't be just like, you know, I like the stock, so I'm buying it. It doesn't work like that. There's a lot of stocks you could buy and aren't going to be there. You got to understand how to value companies, how to value growth companies. And so if I was to say, where are the valuations at for the Magnificent Seven? Are these stocks undervalued, overvalued, or fairly valued, right? And I was to like go through my lessons and become master of stock market and judge those stocks if they're overvalued, undervalued, or fairly valued based upon their business models, historical trends, everything like that, right? I'll tell you it like this. Here's what the deal is. Tesla's trading, I would say, at fair value, but the high range of fair value. And it's only trading there because they have so much growth in future years, okay? And that's as Tesla's my second biggest position in the public count. Apple right now is trading at fair value, but a high range of fair value. They do have a very sticky business model. Their consumers stick around. Their customers stick around. They buy the new iPhones when they need a new iPhone and when their iPad breaks and they need a new Mac and they have the services business. But that stock's trading at the high range of fair value. Amazon, high range of fair value. And the only reason Amazon's at the high range of fair value is because, I mean, they got a super high forward P, but they have massive growth levers all over that company and they have extraordinary bottom line growth right now. Google is a little undervalued right now, but it's the high range of undervalued. Meta is the only one other than NVIDIA that's undervalued right now. Low range of undervalued. Meta is and NVIDIA is as well, okay? Those are only two of those five stocks. And by the way, NVIDIA's got to keep putting up there and saying growth rates to continue to remain undervalued. So let's be clear about that. If NVIDIA's growth was to stop, then it would actually be an overvalued stock. But since they're putting up such incredible growth, they're actually undervalued. And then I would say Microsoft's fair value, but on the high range of fair value right now. So when you look at the Magnificent Seven, these stocks are not necessarily screaming deals right now. A couple are good deals in Meta and NVIDIA still, right? But outside of that, a lot of these stocks are kind of fair value, high fair value. So this is why you should not expect extraordinary gains again from these stocks in 2024 overall. And that's why we could definitely see a high probability of money rotating from those sorts of stocks into other opportunities in the market. And so when I look out there, I say I need to be buying and taking advantage of opportunities, but these are very different opportunities I'm buying and taking advantage of over this next 3 to 6 months than what I was buying at this time last year. It was a very different game, okay? And like I said, no 2 years in the market are ever alike, okay? Never. It's not the way this game works, okay? Alrighty, folks. Hope you enjoyed today's video. I appreciate y'all joining me as always. That was a beast to go through there. Yeah, man, absolute beast. Make sure you check out pinned comment down there. Sign up for our massive Black Friday deal we got coming up. That is 8 days away, folks. Every single one of you needs to be taking advantage of that. Unless you're in my private stock group, then you don't need to take advantage of that. But everybody else, make sure you take advantage of that. $62 access to that is a steal deal of the century. Black Friday, folks. Much love and have a great day.